Perfect.
Okay. Yeah, let me open the chat window too. Oh, hi. Okay. We'll go ahead and go forward from there. If you have some questions, go ahead and interrupt me. I don't mind, and we'll try to handle them as they come up.
Sure.
What I have is a program that allows you to trade a portfolio. I think what you've seen on everything else that I've seen in the market will say, well, here's a trade that's returning 300%, and then they say, oh, well, you buy this long option on this thing for $1, and you're going to hope that it's going to go up to $4 or $5, and that's how you make your high percentage. But that's impossible to trade a portfolio. You can't dedicate your whole portfolio to buying long options and hoping that's going to work. So this is all a plan that allows you to trade a portfolio. And there we go. And I have the standard disclaimer, and basically the disclaimer is just saying that you know, you're still responsible for what you trade. I am not a licensed investment advisor, so these are just ideas and training, and then you can apply the training that you get from me to your own portfolios. First thing I want to start off with is the concept of dumb money and smart money, and you've probably heard that on CNBC or other financial shows. Dumb money is basically the retail investor, and smart money is the so-called Wall Street, the ones that are going to charge you to trade your money. And well, I want to talk about whether it's really smart and rather dumb. So dumb money, you know, trades based on instinct, which I'm not saying everybody does this, but a lot of people say, oh, I like Microsoft, I'm going to buy that stock. I like the way the chart looks, I'm going to buy that. So it's kind of more feeling that they make decisions. They buy stocks after the price has gone up, and sell stocks when the prices have gone down because, oh, I have a loss. You know, I need to get out of it. And so what you're doing is you're buying high and selling low. The other thing that dumb money does is, you know, if you have a bad investment and it continues going down, you can say, well, I'm going to hold this till it gets back profitable again because I don't want to lose money. Well, when that went down, you lost money. So by hanging on to a bad investment, you're losing more money. And what you end up doing when you do that is you end up with a portfolio with a bunch of stocks that are underperforming. And you've sold already your good stocks because you hit maybe a profit that you liked and you wanted to capture that. And so that's actually what this next bullet says. Average investment portfolios typically earn 1 to 2% less than the average mutual fund. Well, that's not so bad. So let's find out what these mutual funds have done. It's the smart money now. So after 10 to 15 years, large cap funds underperform the S&P 500, 85% of them. So, you know, if you're lucky to pick that 15%, you're doing good, but it's not easy to pick that 15%. I'm going to grab a laser setting too, if I can, so I can actually point to the chart. And a laser clicker tools, laser pointer. Okay, so that will help you see my mouse a little better too. After 15 years, though, nearly 92% are trailing the index. So the smart money hasn't been able to perform. And the reason for that is because they include fees, and you know, they're having to keep everything invested regardless of what the market's doing, whether it's going up or down. And they have to have a certain amount that's in cash, which is not doing anything, not earning any money, because they have to have some liquidity when the account goes up or goes down. They have to have money there to be able to close out people's positions. Average return on the hedge funds are just 4.5 to 5%. So I apologize for the dogs barking in the back. I got my son's dogs over here this afternoon, trying to give them haircuts while the weather's nice. So this is the source where I got this number from CNBC website. So what kind of expected returns are, again, this is a little older now because it's something I picked up at the end of 2020. So a couple years old now, but it doesn't change a whole lot. The 15-year returns on each of these, you can see are, pretty marginal. And the reason I wanted to show you that is to be able to set expectations on what returns are. And, you think you're going to get 15% in the stock market. That's a tough thing to do. The professionals don't do that. They're not even meeting these numbers because they're underperforming these indexes. So our goal is to minimize our investment risk. And usually when you do that and get high returns, and when you try to get high returns, what do? You increase your risk. And so they're kind of contradictory to each other. You want to minimize your risk, well, then your returns get lower. And so what we want to do is we want to try to optimize that so we get the best returns with the minimum amount of risk. This whole program is about protecting your money. It makes a big difference if you can save your money, prevent your money from going into a drawdown when the market's down. Because then when the market starts going back up, you're making money where the other people are just trying to recapture their losses. So how do we balance these goals? I want to introduce you to a risk and reward chart, and you've probably seen this already. On the x-axis, we have risk going higher to the right, and on the y-axis, we have return going higher as it goes up. And so we take a look at an investment like bonds. Bonds are typically one of the safest things to be in. They haven't been for the last year when interest rates have been going up because bonds go down when interest rates go up. So it's been absolutely a terrible investment in the last year. Stocks, they have a higher risk, but they also have a higher return. So somehow you want to balance how much bonds, how much stock you have in it to get your best return. A normal investment portfolio that you're going to get from Wall Street or from a broker that you may work with is they're going to say, okay, well, we want you 60% in equities and 40% in bonds. And that ratio will change depending on where you are close to retirement. And you're going to get more and more bonds as you get closer to retirement. And being that I'm in retirement, I don't really want to be in bonds, especially with them performing as bad. But well, let's take a look at that here. So this is the concept of what an efficient frontier is. Efficient frontier is, that means that there's some point along this curve of risk and return that you can get the most amount of return with the least amount of risk. And that's usually some point, tangent on this curve right here. And maybe it's, about right here is maybe what you'll try for, because you minimize the risk, but you've maximized your return. You go further up here on trying to get higher returns, you're adding risk. So that's called the efficient frontier. So a combination of assets that have the best possible expected level of return for its risk. What we're going to talk about is a Sharpe ratio. Some of you probably have heard of Sharpe ratio, but it's a way to measure different strategies and how they compare with each other. And it's a measure of the amount of risk you're taking for the return that you're getting. So if you can think of it as return divided by risk, when return goes up and risk is the same, Sharpe ratio goes up. Where if the return is the same, but you reduce risk, Sharpe ratio also goes up. So either one of those that go in that opposite direction is a lower Sharpe ratio. So we want to look at things that have good Sharpe ratios. So we have also modern portfolio theory. So I'm introducing you to some of the terms that are kind of some of the basis of what I'm doing. And the more you understand some of these terms too, the more it will make sense what I show you in the next few slides. But modern portfolio theory states by adding assets that are diversified with low correlations, it can decrease portfolio risk without sacrificing return. So that's why they do diversified portfolios, because they want to try to diversify the risk in your portfolio, kind of minimize it. But what you've probably all seen though is when the market sells off, that it doesn't matter what you're in, it's selling off too. They get very highly correlated during a bear market. So although that this is a good concept and this is what we're going to try to achieve, there's still risk and things still go down. And what we want to do is we want to minimize that portfolio risk, and we're doing that by using products that have low correlations to each other. So this is a chart of returns, and I apologize for the Y scale. It just doesn't come out very good on this, mostly because it's so high. What we have is this purple line, the SPY, and you can see all the way from back here at this point, that purple line is kind of flat like this, and then starts going up like this. And really, it's been going up the whole time, but this is not in a log scale, so you don't see really how linear it is. But you can see it had a real big pull down back in 2008, 2009, and that was the financial crisis in the U.S. and housing market issues that it had. We had a pretty good pullback at the beginning of 2020, and then back here you can see this is the pullback. This little peak right here is a pullback from COVID, and we've made a little headway getting back to that. We take a look at Model 1, which is one of the options that you can trade with the program that I have. It didn't have a very high return, about the same as what being in SPY did, but it's a lot more steady. You can see during that 2008 housing crisis, it continued to grow at a steady rate, and all the way through. In COVID, it kind of got flat, but you didn't have that drawdown like you did on SPY. By the way, this little drawdown right here on SPY is over 50%. It went from here to less than 50% of what the original price was of SPY. I mean, it takes almost 5 years before it gets back and starts making new highs. It's a long time to be in drawdown, especially if you're retired. When we look at some of the other portfolios that we have is Model 2 and Model 3. Model 2 being the orange, it has a higher return. Model 3, again, has even higher return. You can see it way outperforms SPY. It's going to have a little bigger drawdown, but the performance of Model 3 is definitely worth investing in because of how well it does. What I've done too is this red line is the combination of Model 1, 2, 3, and SPY. So that's that red line through here, and you can see how it's outperformed the market. Now remember, I was showing you how the smart money performed. The smart money had a hard time performing and beating the market. This is about what, 25 years, and look at the outperformance of this the red line compared to what SPY's done over here. So let's look at that risk and the return graph of this. And we look at SPY on the risk that it has. And this is the annualized risk based on it's like a standard deviation number. And it has, the decent return, almost 10% return annualized over that period of time. This is going from 94 to 2021. We have Model 3, which had the higher return, you can see, but it's a lot less risk than SPY. Model 2, again, less risk, less return. Model 1, less risk and return. So if you want to have a very conservative portfolio, you can match the performance of SPY with the Model 1, but have, just a little more than a third of the risk, maybe less than half the risk there, I guess. In Model 2, again, you're outperforming SPY now with about half the risk. And Model 3, you're way outperforming SPY, and you got a lot less risk. I want to introduce you to a term called max drawdown. You're probably familiar with that, but just to make sure, this could be your balance of your account, the amount of equity in your account or the amount of cash in your account, what your account's worth. And it could have new highs and new lows and go up and down as the market changes, or it could be a stock or an index. And what drawdown is that you get to a certain point, and let's say that we'll take this point here, which is the high, and it goes down, goes all the way down to here. And what happens is it drew down 24% from its high. And so that would be a max drawdown, but it did exceed that later, that it was up here and went all the way down to here, which is 26%. Well, it's possible that 26% is still not going to be the max because we haven't hit a new high yet, and it could potentially be that there's new lows coming. So we don't know what that drawdown is going to be yet, what this particular drawdown is going to be. But anyway, this is max drawdown, and when we look at different investment strategies, we'll look at investment max drawdown to compare so that you know what you're doing when you're making investment decisions. This is a chart of the drawdowns. The purple again is SPY, and you can see here's the 2008 financial crisis, housing crisis, going all the way down here, 51% drawdown, and all the way back up here before it starts making a new high. It also had a period back here, 2000, in the dot-com crash, and it took all the way back to 5 years later before it started making new highs again, and only to have it, boom, hit a new low. So it's quite variable on SPY. And again, this is outperforming all the professionals that you pay money to trade. And it's, to me, it's disgusting that they're making all this money trading people's money and not being able to control the investments and beat S&P 500. Again, you see how little that combined portfolios with that red is up here. Just, you know, we're getting about 8% drawdowns as a max over this time frame. And the Model 1 is even less than that. You can't even see Model 1 sticking out. So, yeah, here's a little place right there. That did have a 6% drawdown, but very little drawdown on these. So here's what a table of what these strategies look like. This is the return. So the Model 1 was this is going all the way from 1994 to 2021. Some of the products traded in this in the later years weren't traded back in 1994. And so what they did when came back and did these back testing using these rules is they created an ETF equivalent that applied the same algorithm that the current modern ETF does, so that they could get a price curve of what that would look like longer or further back in history. But this is going all the way back to 94. You know, we're talking, what here? We got 17 years. Is that right? We have average of 9.1%. SPY was 9.5%. So SPY outperformed it during this period in terms of raw return. Not much, but if we look at the SPY standard deviation, it's at 15%, where this only had 6%. But you know, we talk about that Sharpe ratio. Remember, a higher Sharpe ratio means that you have a lot less risk for the amount of return that you're getting. So this has a Sharpe ratio of 1.37, which is a phenomenal Sharpe ratio. So just SPY is just a 0.63. Combine these and average them out, because they're diversified, actually gives you a higher Sharpe ratio. And the other one that we want to look at is this arrow is in the wrong place. It should be down in the worst drawdown. So the worst drawdown is 7% here, 7.4, 8.6. Again, these are gradually getting a little more aggressive, and you can see going from 9%, almost 11% to over 13%. You're going to get higher drawdowns because you're getting higher returns again. And again, adding SPY with almost 51%, which is, you know, drastically more than any of these portfolios. And you know, then you get an average. And I wish I probably needed to mark this up, because I don't know whether this drawdown and this return is a combination of 3 models or whether it has all 4 products in here. But let's assume that it's these 3, because that would probably be where this drawdown would be the lowest. If I included SPY, it would raise it up, of course, because it was so volatile. And the same thing with the return. By adding SPY in here would actually lower the return that you would get on the combined portfolio. So here's 2 other strategies: Index Trader 1, Index Trader 2, and that's combined into this green strategy. And it also has a third strategy called Riot 3X. Now, Riot 3X is something that if you've got a retirement account and you want to have your account really stable, you don't probably want to trade it. But before last year, the 2 years preceding that, it averaged about 100% return per year. Last year, it was probably down about 70, 80% if you stayed in those positions. Although the algorithm that determines what to trade for that strategy took you out of those positions before it lost that much money. And so this is showing if you stayed in those pieces right there, that it would have had a pretty good sized loss. But again, still, it's massively higher than these other strategies. But that's a big loss to swallow right there. Here's the combined, and that includes Riot, Index 1, Index 2. Again, I don't remember whether I included SPY on that, but it probably wouldn't have made a bunch different. SPY is this purple line way down the bottom. And again, these are returns over this time frame. And this also started in 2010, I believe, maybe 2011. And the reason that it started back then is because the products that are traded in the Riot strategy weren't available before that. We have all those leveraged ETFs now that we didn't have back then. Again, here's the numbers on that. Index Trader 1's 14%, so it's as good as any of those other model strategies, but it does have a lower Sharpe ratio, so it's a little more volatile. Index Trader 2, 12% is not bad. Again, Sharpe ratio is better than SPY, but here's SPY. And here's Riot, 27% return average from these 11 years. And when you combine them all, 20%. And again, that may be these three, or that may be all four combined. First drawdown on Riot, 60%. Now the SPY's drawdown is only 24% here. And the reason for that is because it doesn't include 2022, which was, I think about 30, 35% drawdown at SPY, or it doesn't go back to 2008, which is like 50% drawdown. So it's still a lot of drawdown, right? Again, that's way more drawdown than you want to have in a retirement portfolio. All these are pretty high. All right. So here's the correlation matrix for those. Index Trader 1, I guess you know how to read these, where Index Trader 1 is correlated to Index Trader 2, to 3, 4, and Index Trader 2. I mean, they're fairly correlated to Index Trader 1, Index Trader 2, because they're, oops, we got a 10-minute warning on Zoom. Let's see if I can get rid of that. It went right on the top of my screen. There we go. All right. I don't think we'll get into this right now. I think we have enough of that. And again, we have the high return strategies with the correlation. So here's the Index Investor 1, Index Trader 1, and you can see the blue line nice and steady. It did have a pretty good pull down here. The main reason this had this drawdown here is because when the market started going down, what it did, it pulled you into bonds. Well, normally when the economy is having trouble and starting to get bad, what do? They lower bond rates, which increases the value of bonds and becomes an inversely correlated asset. And this year, since the market was doing too good, we're trying to cool down in a market instead of trying to go into a market, trying to pep up a market. The bond prices went down. So one of the things that I had our subscribers do is go into commodities. Since we had high inflation, commodities were inflating, and they didn't take this kind of loss here. But you can see back here when the economy was bad that those bonds held up real good. It's not real good this time. Let's take a look at the numbers on it. So if you invested $100,000 back here in 2003 and let it go that whole time, you're getting almost 10% return on SPY. You come out with $679,000. That's not bad. I would take that. doesn't seem too bad. You have your 51% drawdown back here, and you have a Sharpe ratio of 0.64. We go back here, and this is a big difference. You're getting almost 16% return, and the difference between that is, it's more than double. You got $1.9 million instead of $680,000. You're just about as volatile as far as what your account balance is going to look like. Best year, it made 51%. Worst year, about the same as just SPY was by itself. The biggest drawdown, 35%, which is pretty big, but that's this right here that we moved out of. In Sharpe ratio, again, it's 50% higher than that. And it's just partially correlated with the S&P 500. So this slide is meant to show, the example of what you might want to do when you're allocating your money. You might want to just, if you want to be very conservative, you can put 100% into the Model 1. If you're not so conservative, maybe what you can do is you can put 50% into the, we don't even have the mega model, but let's say 50% into Model 3. And we don't have this one anymore either. 5% into right, 30%. I'll update this slide too. So how this program works, do we want to stop here and go ahead and restart so we don't run out of time right at the end here? Is that all right with you guys?
Yeah, that'll be better, I think.
So we have to click the same Zoom link, right, Rick?
Yeah, the same Zoom link is going to be good. I just didn't want to be right in the middle of an important part and all of a sudden it goes dead there. So let me stop that and I'll restart it up immediately. And so rejoin back in that Zoom and we'll be good for another 40 minutes, okay?
Okay.